December 10, 2008. A man stands in a Manhattan penthouse. He tells his two sons that every dollar their clients own is gone. $65 billion. 37,000 accounts. None of it real. He is a former chairman of NASDAQ. 6 formal complaints reached the Securities and Exchange Commission over more than a decade. Not one stopped him. The explanation begins with $5,000 and a lifeguard. Bernard Lawrence Madoff registers Bernard L. Madoff Investment Securities in July 1960. He is 22 years old. The firm opens with $5,000 in capital, earned from summers as a lifeguard, and additional money borrowed from his in-laws. The first office is a small broker-dealer operation focused on penny stocks. Within 5 years, Madoff invests in an IBM mainframe. By 1970, the firm is among the earliest on Wall Street to use computer-aided trading. The IBM system processes quotes and orders faster than the manual phone-based method. Electronic trading becomes the foundation of the firm's growth. During the early 1970s, Madoff expands into market making for the new NASDAQ exchange. He secures a seat on the NASDAQ board. Industry records show that by the late 1970s, Bernard L. Madoff Investment Securities is handling a significant share of NASDAQ trading volume. The firm's reputation is built on speed and discretion. Madoff's technical team helps design the electronic order routing system that supports NASDAQ's launch in 1971. In March 1975, Madoff is elected chairman of the NASDAQ stock market. He serves 2 terms. During his tenure, he champions the hybrid market system, blending floor trading with electronic quotes. He promotes the 3-level quote system, which becomes the basis for the consolidated tape. By the early 1990s, the firm's capital base exceeds $700 million. Bernard Madoff is recognized as a pioneer of electronic trading and market structure. His public statements emphasize integrity, transparency, and innovation. The firm's legitimate operations are ranked among the top 1% of U.S. securities firms by trade volume. Madoff's stature in the industry is documented in NASDAQ archives and contemporaneous news reports. The next phase of the story begins when the firm moves into the Lipstick Building on 3rd Avenue. Inside the Lipstick Building at 885 3rd Avenue, Bernard L. Madoff Investment Securities occupies 2 distinct floors. The 19th floor handles legitimate market making. The 17th floor remains sealed and isolated, accessible only by magnetic badge and a private elevator. Lease records and badge logs confirm that fewer than 30 employees work on the 17th floor. Most staff from the main office never set foot inside. Entry is tracked and limited to a fixed list of personnel. Visitors and auditors are excluded. The 17th floor houses a single IBM AS400 mainframe. This computer runs a nightly batch process. Each night after market close, the system generates client statements and trade confirmations. The job schedule is set for 2:30 in the morning. The output produces fabricated records of trades that never occur. All trades list a static depository trust company settlement number. No genuine DTC clearing takes place. The system formats statements, prints them, and prepares digital files for distribution. The same computer maintains the badge access logs and internal audit trails. All client cash is funneled into one Chase Manhattan Bank account. The account receives deposits, records, withdrawals, and holds all client funds. No external custodial or clearing records exist. Internal memos and bank statements show no movement of cash to outside brokers or clearinghouses. At the end of each day, original documents, trade tickets, and client forms are collected. A high-speed shredder on the 17th floor destroys the paper. Shredded material is placed in a sealed dumpster. The process removes the primary evidence of fabricated trades. The operation produces a closed system, physical segregation, a single computer, one bank account, and a routine destruction of records. The mechanics of the fraud remain hidden beneath a structure that appears orderly and secure. Bernie Madoff presents the split-strike conversion strategy as a market-neutral product. He describes three components. First, client funds are allocated to purchase a basket of S&P 500 stocks. Second, the portfolio is hedged by buying put options on the same index. Third, covered calls are sold against the position to generate premium income. Prospectus language claims this combination reduces downside risk while allowing for modest gains in rising markets. The strategy is marketed as a way to capture steady returns, regardless of market direction. Madoff tells investors that the net effect is near zero exposure to market swings. He emphasizes the presence of a cash reserve. The strategy, he says, keeps a portion of assets in cash to protect against volatility and provide liquidity for withdrawals. The pitch relies on technical terms, option legs, strike prices, market beta, and hedging ratios. The approach appears familiar to institutional allocators and sophisticated individuals. Madoff's explanations reference standard option pricing theory and cite real-world examples of similar strategies used by major banks. No mention is made of trade execution or clearing. The focus remains on the theoretical structure. The language is designed to reassure. Risk is described as managed, losses as minimized, and returns as consistent. The technical veneer gives the appearance of a legitimate, low-risk arbitrage product. Investors accept the explanation. The absence of volatility is attributed to the effectiveness of the strategy, not to the absence of trades. Aggregate client statements list $65 billion in paper profits across 37,000 accounts. The number reflects fabricated gains, not actual cash. Trustee records reconstruct the balances. Each account shows a steady upward trajectory, regardless of market conditions. No losses appear, even during periods of broad market decline. The illusion is maintained through monthly statements generated by the IBMAS 400 system. These documents report precise returns, often between 8 and 12% annually. The statements reference trades that never occurred and balances that never existed outside the firm's internal ledger. Admission to the fund is controlled. Prospective investors receive rejection letters stating the product is at capacity. These letters are kept as proof of attempted access. Waitlists are maintained. The firm's exclusivity is reinforced by feeder funds that promote participation as a rare opportunity. Correspondence from feeder fund managers uses phrases like reserved for select clients and invitation only. The perception of scarcity increases demand. Investors view acceptance as a sign of sophistication and status. The numbers accumulate. By 2008, the total reported value exceeds $65 billion. The exclusivity narrative persists. The combination of paper wealth and restricted access creates a self-reinforcing cycle. The scheme's scale and social gating discourage skepticism. The illusion remains intact until external events force a reckoning. In November 2005, Harry Markopolos sends a 21-page memorandum to the Securities and Exchange Commission. The document is titled, "The World's Largest Hedge Fund is a Fraud." It lists 19 specific red flags. Markopolos details mathematically impossible returns, the absence of third-party custody, and the existence of a single Chase Manhattan bank account for all client funds. He notes that no trades clear through the depository trust company. The memo explains that the reported performance cannot be replicated by any known investment strategy. Markopolos provides step-by-step instructions for verification. He recommends that the SEC request DTC records and compare them to client statements. The process would take less than 1 day. The memo is received by senior SEC officials. It is filed and not acted upon. Internal emails, later released by the Office of Inspector General, record that staff consider the submission a low priority. No effort is made to verify trades with the DTC. No site visit is scheduled. The 19 red flags remain uninvestigated. Markopolos continues to warn the agency through 2007. The SEC receives 6 substantive complaints about Madoff between 1992 and 2008. None result in a substantive investigation. The opportunity to halt the fraud is lost. In October and November 2008, Bernard L. Madoff Investment Securities receives withdrawal requests totaling $7 billion. The sum exceeds all available cash. Internal records show that every client deposit is held in a single account at Chase Manhattan Bank. There are no external assets to liquidate. No securities exist to sell. The IBM AS400 mainframe generates a negative cash balance for the first time in the firm's history. Redemption requests arrive from institutional feeder funds and private clients. A $2 billion demand from Fairfield Greenwich is followed by $4.5 billion in additional orders. Madoff's staff attempts to secure emergency credit from J.P. Morgan Chase, Bank of New York Mellon, and other lenders. Each request is denied. Correspondence cites insufficient collateral and concern over asset legitimacy. Attempts to raise bridge loans from personal contacts fail. On November 15th, Madoff instructs staff to liquidate $1 billion in securities, but no such securities exist on any clearing ledger. By December 1st, a final appeal for a $3 billion loan from the Federal Reserve is refused. The firm cannot meet obligations. The arithmetic of cash flow exposes the absence of real assets. The scheme collapses under the weight of its own promises. The man regulators consulted on market integrity constructed the largest fraud in United States financial history. The same oversight failures persist in current systems. Complex structures and reputational shields remain effective barriers to detection. The mechanism is unchanged. Risk is embedded. The lesson is procedural, not personal.